So spread in currency markets is that thing that when price goes above your target, you watch candles literally touch your target order, but the market never fills it. It's also even worse, that thing that when price doesn't even touch your stop loss, you still get stopped out even though there wasn't a candlestick or a wick that actually touched your stop loss order. Unfortunately, you still got stopped out. I'm sure that's happened to you before, and that is all because of spread. And if you don't understand it, then there's no way for you to fight against it, which is why in this video, I'm going to be telling you everything you need to know about spread to help you battle against it and kind of incorporate it with your trading. There's no getting around it, but there are things we can do so that it has less of an effect on the outcome of our trades. So let's go ahead and dive into today's video right now. So spread is what you see whenever you pull up your order page. Right here on the pound New Zealand, this is my order form. Every market is every brokerage, every platform will have one of these, and it will say sell and give you a price you can sell at. It will also say buy, give you a price you can buy at. Or it may say bid, which is sell, and ask, which is buy. So it's either gonna say sell and buy or bid and ask. Bid is sell, ask is buy. Either way, that's not something that's super important. What you need to understand is what that means is that this is the exact price you can buy this currency pair at right now, while this is the exact price you can sell it at right now. The difference between those two prices is called the spread. You can see that in the middle here. I know it's tiny, I'll zoom in on it. And this spread is how brokerages make money. This spread is kind of their fee that they charge you to use their data to actually place trades using this brokerage. And I expect it. I didn't have to build the platform that I trade on. I understand that they need to charge a spread. Sometimes I do think it gets a little fishy and a little bit too high, but it is what it is. The main thing you need to understand is what the spread is, how it affects your trades, and how you can prepare for spreads while trading in the currency market. So let's dive into that now. Right now on the screen, you can see that we have a 4 pip spread on the pound New Zealand. What that means, we're diving into what a spread actually means for your trading when you're placing a trade. If the spread of the pound New Zealand right now is 4 pips and we have the close of this candle that we want to enter on, that would mean we want to enter at 1.9345. Let's say you place a buy trade and you see something like this. You see the market fill you, and once you press buy, this is where your order actually is. This is where your buy order actually happens, is this black line. And you're sitting here going, what the hell? That's not where I placed my order. My order should be right here. Have you ever had that happen before? If you have, the reason this happens is due to spread. The reason this happened is because you weren't looking up here at the spread, which is currently 4 pips, which means if you place an order at 1.9345, it will fill you 4 pips above that, which would be 1.9349. Now, that's one thing that spread causes, and it sucks. Trust me, I can't stand when I get a fill in an order without looking at the spread and then realize, shit, I should have looked at the spread. That does suck. But an even worse scenario is something like this. Let's say we're involved in this trade, and let's say we got the perfect entry. Whenever we placed the trade, there was no spread. That'll never happen, but let's just pretend. And then we see the trade moving. Oh, cool, we got like halfway to the target. That's nice. And then we see, oh, we almost hit our target right there. That is incredible. I'm super excited, super excited. Boom. You all of a sudden get stopped out. But you know why? Because here's your stop loss. Why would you be stopped out when there's this much room between price and your stop? I can literally see space. Why did I get stopped out? Why did I lose money on this trade? I know I've been there, especially at the beginning of my career when I didn't understand spread. I got frustrated about this situation, God knows how many times. So the reason you were stopped out on this trade is because, remember that 4 pip spread? Where did price go at its lowest? Lowest price, I'll put a line on the chart just to make this super simple for you guys. The lowest price, I'm gonna put it in blue, is right here. So if that's the lowest price, and this is our stop loss, and our order got triggered, why did it get triggered? Again, remember that 4 pip stop loss? From the lowest price down to an actual stop loss you have placed with a limit order is only 2 pips, 1.9, right at 2 pips. Therefore, price with your spread actually went 2 pips below your stop loss, which is why you got stopped out on this trade. And I know it sucks, but this is just a part of trading. We're going to go over some things you can use in order to prepare for it and hopefully keep it from being such an issue a little bit later on in the video. But one more scenario we're going to go over really quickly before we do that is, let's say that this magically didn't stop you out, and instead you get to watch, and let's say this didn't stop you out either, even though we got right there at it. For this example, that's what we're going to say, because this gives me a good opportunity to show you this scenario as well. Here you go. Oh my gosh, yes, profit. I didn't get stopped out all through here, and now price went above my profit. What's bad for me is I would wake up in the mornings after placing a trade at night and see this, and then price would do something like this, and I would see a negative number in my account and go, what in the hell? How did I lose this trade when price clearly hit my target? Have you ever been? Leave a comment below if you've ever been there and ever thought that. So let's put a horizontal line, a green one on the chart. This is where you have your limit order. So right here at this green line, we can see. Now we have to remember yet again, maybe at the time that this order was hit by price, the spread was the same 4 pips. Let's say it was. If that's the case, then where does the market really need to go to hit your 4 pips? I mean, to hit your actual target. If we're at 1.9351, then we would need to be at 1.9355. So that means your actual target would have needed to be up here. We'll do that in blue as well. So this is where price would have needed to make it to in order to actually fill your trade because of that 4 pip spread. Now, this is the case no matter what the spread is, and there are variations of the spread depending on the currency pair you trade, the time of day it is. A lot of different factors go into it, which is what we're going to dive into now. Hopefully now, though, you do have an understanding of what spread is. And if you do and you didn't before, smash that like button for me. Tell me out. Don't forget to subscribe if you are new. If you're already subscribed, welcome back. Forgot to do all of that at the beginning of the video. But let's dive into some of the ways that we can keep this from affecting our trading in a major way. There's no way to completely exclude spreads. There's a way to get really close, and that's called paying commissions, which we'll talk about later on. But right now, let's talk about some ways other than paying commissions that can keep you from having this affect your trading in a highly negative way. The first thing is time frame. This is the reason that I have such a problem with people telling beginners that they should day trade, because this is something that most beginners don't really understand. Some intermediate traders don't even understand this. And if you're starting out trying to trade on the 5-minute chart, not understanding what spread is, then this is going to happen to you over and over, and you're constantly going to have questions going, why did I get stopped out of this trade? Why didn't this trade hit my targets? Whereas if you were on a, let's say, 4-hour chart, let's talk about the difference here. Let's say you wanted to do the same exact thing on this chart that we did on the 5-minute chart. Let's say you want to buy right here where price is at 1.9345. But again, you have that 4 pip spread. So instead of 4.5, it would be at 4.8. Now look how much smaller this looks compared to all the candles. The 4-hour chart is going to move a lot more. If you placed a trade at our black line right here and got filled at the blue line, would that affect your trade as much as it would on a smaller time frame? No. And what I mean by that is on a smaller time frame, like a 5-minute chart, you may be looking for 15, maybe 20 pips max for your target. Maybe, actually, most of the time, maybe lower, maybe like 10 pips. If you're looking for 10 pips for a profit and your spread takes you out of 4 of them, then there's very little likelihood you're going to hit that. Whereas on a 4-hour chart, your profit is probably going to be somewhere between 40 and up to hundreds of pips. So with this being the case, that 3 pips doesn't matter nearly as much. So the first way we can keep the spread in the currency market from affecting us so much in our trading is by trading higher time frames where our targets are much bigger. Now, I know that's not super attractive to a lot of people because they want to day trade so they can make money fast. But what I would suggest is always keep day trading as something you can do, but start with swing trading so you get the hang of everything. Start with swing trading. Practice here until you're actually profitable swing trading, because if you're not profitable on higher time frames, if you're not capable of actually becoming profitable there, then you're not going to be profitable day trading either. So really what I'm preaching here is patience. patience in your trading journey. Be sure you can be profitable in higher time frames. Get to know your brokerage, your platform, how to do trades, get to know spread, get to understand your system better on higher time frames. Then you can decide whether or not you want to drop down to those smaller time frames. But please do not start on small time frames, especially if you didn't even know what spread was or understand how it worked before this video. Now, what are a couple of other ways we can do this? Well, as I said earlier, time frames, time of day can affect it. But before we talk about time of day, let's talk about currency pairs. The pound New Zealand by far has one of the highest spreads. That's why I wanted to use this as an example, because it's an extreme scenario. If we go to the euro dollar right now, for instance, you can see that we only have a 1 pip spread. So one of the ways, if you said, Steven, I'm not listening to you, I'm not going to swing trade, I want to go down on smaller time frames right now. Well, if you do, one of the things you could do in order to keep the spread from affecting your trades so much is only trade currency pairs that have a very low spread. The top 5 major pairs normally have very low spreads. And this is a generalization. Not always. During high impact news events, spreads go crazy. At 5 p.m., every Eastern Standard Time, that's where I'm at, is in Atlanta. At 5 p.m. Eastern Standard Time, spreads go crazy everywhere. So this is just a generalization. But generally, the top 5 major pairs, which are the euro dollar, the pound dollar, you can look at the spread while I do this. The spread's right here. The pound dollar, the dollar yen, the Aussie dollar, and the dollar Swiss essentially normally will have pretty small spreads. So that's the second way you can kind of account for spreads in your trading and keep it from messing your trades up too bad, is to trade pairs with very small spreads. Next is time of day. You want to be trading away from times like 5 p.m. And 5 p.m. is really, I've seen spreads really low. Like right now it's 2:30 a.m. And since it was probably somewhere near 10 p.m., spreads have been super low on like the euro dollar and other major currency pairs. So really, the only time you want to avoid, I guess you could say, is something like between 4 p.m. and somewhere near 9 p.m. Those times I would completely avoid trading, especially on lower time frames, because spreads are going to be a bit higher than usual during those times. After that, at least from my experience, do your own research, check it out, watch the spreads during whatever times you plan to trade to make sure they don't just go crazy like they do at 5 p.m. But from my experience, normally the harshest spreads happen between 4 and 9 p.m. And after that and before 4 p.m., they're normally pretty normal, actually. So those are some ways that you can keep spread from affecting your trading so much without paying commission. But now let's talk about how you can drastically reduce the spread that you have. Almost every brokerage, and I'll throw something on the screen here while I talk to show you where it is on Awanda, which is the brokerage I use. On Awanda, they have a commission-based platform. What a commission-based platform does is instead of you paying the full fee to trade with this brokerage, to use their data and trade through them, instead of the full fee being with the spread, you actually have an opportunity to pay on a per trade basis. And I think Awanda charges $10 per full standard lot that you trade, but this is in and out. So this is something that I would never suggest to someone with a small account, because the amount of money you're going to be making. Let's just picture this for a second. Let's say you have a $1,000 account and you want to trade a trade with a full standard lot and you have a $50 risk on that trade. Well, if you're trading with a commission-based account, the reason I tell people to shy away from this if they have smaller accounts is because the spread may not affect you too bad. But if you're trading with a $50 risk on a $1,000 account, you're already risking 5% of your account. And then you add $10 to that for the entry. And then you add another $10 because it's in and out for the exit. You pay another $10 when you exit the trade. And let's say you lose the trade. Now, instead of losing $50, you've lost $70 because you're paying commission. So until you get to a point where you are consistently profitable over a long period of time, and you just want a commission-based account because you have a pretty large account size, and you can tell, you'll be so experienced at that point that you'll know if a commission-based account is right for you or not. So what I'm telling you now is I would probably shy away from a commission-based account. Even though it does help you with spreads, it's going to cost you money. And with a small account, it's a cost you really can't afford to lose at this exact moment. So that's my spiel on spreads. Hopefully it helped you to learn and understand exactly what they are and how you can minimize the effect, the negative effect that they have on your trading. I hope you enjoyed it. If you did, make sure you click that like button. Make sure you're subscribed below. If you already subscribed, thank you so much for watching. If you watched the full video, leave me a comment. That is awesome. I really do appreciate it. And I'll talk to you guys in the next video. See y'all soon.